Hey, I'm Anthony Dejager. I work here at my office at the Ag Center, and now is time for Ag Tips. Today we're going to be talking about some of the different types of entities that some of my clients or people that are associated with the Ag Center will get into in order to do business here. Choosing the right entity is really important because you want to know the rules to the game before you have to go play. And getting a lawyer or someone that has an idea of the rules to help you is the best way to get started. When I'm starting an entity with a client, we're really looking at 6 main things. The first one is going to be liability. We're also going to look at management. A couple of the more important ones are money in and money out. How do we handle that? And then we're looking at a tax strategy and also an exit strategy, or I guess what some people would call succession planning. There's also other factors like licensure and securities regulations, but for the most part, the closely held family companies and the ag-related companies just have to worry about those first main 6. One of the first main factors we want to talk about when deciding what type of entity to put you in is liability. And when you think about liability, I kind of ask the question, like, what if I told you that you could do business and something could go terribly wrong within that business, yet you wouldn't be personally liable? That's what liability protection is. And in California, there's really 2 things that you got to do to have liability protection. First thing you got to do is you got to pay the state $800 a year. It's just kind of a flat rate, no matter what kind of limited liability entity that you use, that they charge to give you that right to protect yourself. And the second thing you got to do is comply with the rules, right? So you've got to keep the company separate from your personal as far as assets and expenses and things like that go. We call this a corporate veil. So on each side of the veil, one side would be the company side where you operate your business expenses and kind of the happenings of your business. The other side of that veil would be the personal side. And that's where you've got different assets, such as your home or your accounts that are not related to your business, that are protected by that veil in between. Maintaining the corporate veil is not all that complex, but you do want to make sure that you're not what they call commingling, right? An example would be a business expense. So if you wanted to buy a gift as a bonus for an employee, such as jewelry, you could buy that employee, call it a watch. But if you wanted to buy a gift for your spouse, a bracelet, which is somewhat similar, you couldn't use company accounts and company funds to buy that personal gift for your wife. You'd have to take the extra step of having the company pay you before you buy the gift. Just a quick example, but the point here is that you've really got to separate what's on each side of that veil. So there's a company side and there's a personal side. And as long as they're separate, you're gonna have that limited liability in California, where your personal assets are not subject to the liabilities of whatever might happen to the company, whether that's debts or legal claims or anything like that. Another factor that we consider when choosing a different entity is money in. One of the questions we ask is, how much money are you gonna need to start this project, to start this company? That's a consideration that might have an effect of the different type of entity you use. Another question is, who's responsible to contribute the money? If this is a partnership and you've got 2 people in, is it an equal contribution of the initial funds, or is there some type of separate agreement there, right? We set a lot of clients up where one partner is submitting a significant amount and the other partner is committing to sort of a sweat equity promise, so that without putting in the initial money, they can work towards making the company profitable for both people, even though the majority got put in from another person. There's other things to consider, like if it's not money in, is it property, is it equipment, other things like that, is it permits or licenses? So all of those have to be taken into consideration when you start a company, especially a partnership, because it's gonna move forward, it's gonna expand or shift or grow or shrink. And how do we account for those initial contributions is really important. Another thing that you wanna think about, which could potentially be problematic is what happens when you need more money. So two partners start a partnership. They've each put in the right amount of money to start it. And then there's a shift. Something changes or something goes differently than is planned. You need more money. Can one partner force the other to contribute more or vice versa? That's a question we got to ask, and all those are different considerations in what type of entity you're going to choose. Along the same lines, another consideration we're going to look for is money out. Money should eventually come out of the company. If you're doing this right, that's really going to be the point of forming a company or forming an entity to hold property. At some point, money's going to come out. What is the order it should be distributed? Is there a hierarchy or what we might call a waterfall to the order that it comes out? If partners contributed a different amount to startup, is there a preferred return coming out based on what was initially contributed? Or is it going to be just a straight rate coming out? What is the agreement that you might have with a partner, or if there's a group of partners, say about the budget? How are we going to handle those kind of things? Who's making these decisions regarding the money coming back out? And really, especially when the partnership might shift into maybe terminating, dissolving. If you're closing down the company, or if you're moving it from one partner to another, again, there's value created over a term of a partnership. And when the money comes out, it's very important to have an agreement among the partners as to how that's going to go, so that it's clear expectations when it becomes that time. Another aspect we're going to look at is management. Essentially, who's going to run the company, whether it be a corporation or an LLC or limited partnership, any type of partnership, who's in charge. And when you establish who's in charge, what kind of limits to that power are they going to have? So if you've got an LLC and there's a manager that's designated to run the day-to-day operations for the company, you might even authorize this manager to sign documents and obligate the company. Are you going to create a threshold or a limit as to where that power stops? And if there's an expenditure or an obligation in excess of a certain dollar amount, is that going to require a majority or even unanimous vote from the rest of the partners? So when you're looking at management, we really use that as a way to differentiate which type of entity might be best for you and your business. Another thing when you're looking at management of a company is, what if something changes, goes wrong, shifts? Lots of things can happen. How do you appoint a new manager? What's the process for that? Is there voting involved, and who has the rights to do so? Also, does the manager have a right to compete? An example here is, if you've got a toy store, can your manager of the company sell toys on the side? Because that might be hurting the company. But if you've simply got a holding company that you own real estate, the manager has to kind of oversee that, but probably wouldn't be a problem if that manager held property on the side. So those are two examples of at times when a manager is competing with the company, and one is probably not a good thing and the other one might be just fine. Another factor to consider is tax strategy. Is what tax consequences will your entity choice leave you with? Main differences here is going to be a corporate tax structure versus a partnership tax structure. And a partnership tax structure will cover like a general partnership, a limited partnership, even a limited liability company, among others. But it's going to have different consequences. An LLC, for example, is going to have what's called a gross receipts tax, right? Like, what if I told you that you could lose money in your company, except based on the way you did business, you'd have a lot more taxes to pay, right? That's something an LLC can get you into trouble with based on the gross receipts tax that a corporate tax structure would. And if you're doing a corporate tax structure, whether it's C or S Corp, is going to be determined whether or not there's single or double taxation. With single taxation, we call that a pass-through, meaning any income coming from the company is going to go right to the shareholder of the corporation. And that's something we want to think about too, if we filed a Chapter S election or not. Employment tax can be an issue. With a corporation, the shareholders can be employees of the company, but with any type of partnership that we talked about, limited partnership, general partnership, limited liability company, the partners cannot actually be employees of the company. So we can get together with your accountant, we can kind of do some analysis to figure out, when we're setting you up with a company, as far as tax structure goes, what's going to be the best fit for you. And exit strategy. One of the last things we talk about, which might be the most important, is an exit strategy. And an exit strategy I sometimes call succession planning. It's how do you want to move on? How do you want to get out? What if you want to stay in and your partner wants to get out? And there's really a lot of things we could talk about that would really be too long for a video. But if you're talking to your lawyer and he's getting you set up with the best entity, you're really gonna wanna consider these things. We run into situations all the time where a group will go into this and something will change. It could be a bankruptcy type of event. It could be a divorce where a judge will offer someone's partnership interest to the spouse. Well, now your first partner didn't really intend to be partners with the spouse. So how are we gonna deal with that? There's really a lot of things as far as succession. Can you put up your partnership interest or your shares in a corporation for sale? Can you sell them on the open market? What if your partners or the other shareholders object? So those are really some considerations to think about. What happens when a partner dies or becomes incapacitated and no longer has the capacity to contribute as they once did? So an exit strategy is very important because when you go into an agreement with eyes wide open and a clear understanding of what each partner has to do and what's expected to them, then there's not going to be a problem on the way out. But when it's not discussed, when it's left to interpretation, so to speak, then it's really ripe for the potential to develop some acrimony or hard feelings between partners who would have otherwise had a great experience working as partners together. So if you've got an attorney or if I'm working for you, we're certainly going to talk about all these things and what's going to be the best fit for you regarding an exit strategy. So here's my best ag tip for the day. Get into an entity that's right for you. Whether you're starting a new company or restructuring a company, we might put you into a corporation, a general partnership, a limited partnership, an LLC, or even a sole proprietorship based on how these factors work for you. So get your right entity and set yourself up for the best possibility of success.